All right. Good morning, everyone. As you could already hear, this meeting will be recorded, so just a heads up. My name is Jeanette Kiesling, and I'm the Executive Director of GABA, the German American Business Association. We're very happy to have Andrew Fisher and Andres Pilarevs of Cerity Partners with us today, and they will provide their expert advice and insights on saving, investing, and taxes for international families. So welcome to both of you. Before we begin, please make sure that you are muted during the presentation. There will be ample time to ask questions after the presentation, and you can either drop them in the chat or raise your virtual hand, but please don't unmute yourself until after your name has been called. And finally, as I said, we will record this session and make it available to all the registered participants today. And Andrew and Andres kindly offered to also follow up with a one-on-one consultation offer where you can discuss your very specific needs further. We will reach out to everyone here afterwards and provide all the information for that. So without further ado, let me hand it over to Andrew Fisher.
Thank you so much, Jeanette. It's really wonderful to be here today. Thank you all for joining us. We're going to talk about some financial planning and financial advice on coming to America, savings, investing, and taxes for international families. I'm Andrew Fisher, and it's been now 13 years since my first presentation to GABA. I wanted to show you, Andres, a slide of me presenting in person to GABA at this was at the MacArthur Park restaurant in April of 2012. So I've been very blessed and privileged to be welcomed back. And so we always try to give really, valuable insights to this unique cross-border community. A little bit of a bio on me. I've been a wealth advisor for 23 years, always as a fiduciary in an independent fiduciary capacity. I've been focused on cross-border families for that entire time. I also was the author of a book called The Cross-Border Family Wealth Guide that's on Amazon. I am a CPA and a CFA, so I did work prior to becoming a wealth advisor on Wall Street doing international stock research and also at Price Waterhouse. So back when you met me here, I was the founder and manager of Worldview Wealth Advisors, a firm that I ran for 15 years. Andres, we can move on. Since then, in 2020, I merged Worldview Wealth Advisors into Cerity Partners. We are one of the top 5 largest independent wealth management firms in America. We're fiduciary. We earn no commission. Our clients' best interests are number one. We manage over $150 billion with 1,500 colleagues, helping over 30,000 families. And our approach, our service is holistic, right? Which means that we both manage investments, but we spend a lot of time on more holistic wealth planning, financial planning aspects, tax planning, and estate structuring. Andres, I lead the cross-border team here at Cerity Partners, and we have a terrific team of colleagues all focused on this cross-border area that we're going to focus on today. I'll be joined by a new face. Many of you remember Libby Dawson, who's joined me a number of times in these presentations. I'm joined by my senior colleague located in Washington, D.C., Andres Pilajevs. Is that right?
Yeah, the J is silent, Andrew.
Okay. Want to introduce yourself, Andres?
Yes, absolutely. Thank you. Hello, everyone. My name is Andres Pilayevs, and I am a principal and a cross-border wealth advisor at Cerity Partners. My personal background is that I was born in Latvia. So like many of you, I came to the United States across the Atlantic many, many years ago. At this point, over 20 years ago. So majority of my adult life has been spent here in the DC region. And from personal experience, I got to really see all the difficulties that our community has to deal with coming to America, having family in multiple places in different countries, different tax systems, and navigating those questions. I found that there's really no one single good source of information for people like us, and I decided to make this a career by helping others navigate these questions. So I am a certified financial planner. I hold a master's degree in personal financial planning from the University of Georgia, and I help our clients with all of their cross-border tax and investment questions and needs. I'll also mention that our team also is very international. We actually have people from Germany, Italy, Brazil, Latvia, as I mentioned, and we speak many different languages. So very international team and very diverse background that allows us to serve our clients better. And by nature of my work, it just happened to be that the largest number of my clients that I work with are actually connected to Germany. They're either German citizens living in the US or US citizens living in Germany. So really looking forward to presenting today.
Thank you, Andres. So let's just kick into what the topics to be discussed here are. This is a brand new presentation we put together, and we really tried to think hard about what are the key issues on people's minds today. And so the organization you'll see here, I'll just read them off: creating wealth and saving strategies, an investment strategy for people who are more global, real estate considerations, which is always really important to Europeans in particular, cross-border tax planning, minimizing taxes, maximizing wealth, and estate planning. There's a lot more focus these days on getting one's estate in order, having it be, and thinking through potential wealth transfer rules and so forth. So I'm going to the most of the presentation was designed around U.S. Germany, and in particular on coming into the U.S. But there's quite a bit of it that's also about leaving the U.S., maybe down the road later in life. And there's also a lot here that's not just U.S. Germany, because a lot of these rules, a lot of these issues are the same for someone from France, from some other country. So we try to be pretty inclusive. We will have a Q&A session at the end, hopefully the last 10 or 15 minutes. And so, Andres, can you go back real quick? There, yeah, there you go. And please put your questions into the Q&A chat room, and we will try to get to them. Really quickly, I want to just define what we mean when we say cross-border. Who's cross-border? And for us, the way we define it is American expats, American citizens who live permanently outside of the US. They're navigating some pretty unique challenges because as a US citizen, you're always reporting back to the US no matter where you live, and you're probably reporting, maybe it's in Germany or the UK or wherever. And this, of course, would also be the same for a foreign-born person who came here and got a green card or became a dual citizen and then moved abroad, right? The second classification are foreign-born people coming here. We call that inbound. So there's outbound and inbound. I imagine a lot of people on this call will be inbound. And then the last one is non-US residents. This would be foreign people who decide to move some assets in the US and hold it here, but they're not a US person. So that's a smaller part of the community that we do. Andres, we organize this talk into what we call sort of the 10 top smart moves. I'm not going to read these here, but you'll have them in the deck. But we're going to talk about each one of these, and I'll turn it to Andres to tackle the first five.
Yes, thank you, Andrew. And the first of the topics we'll start with is the residency. And the name of it is Don't Be an Accidental Resident. So residency is the topic that we spend a lot of time on with our clients to help them understand what does the tax residency actually mean. And the residency is the foundation of every tax question, every decision, investment decision, filing requirements, disclosure requirements. And essentially, if we're talking in the context of the US and Germany, both countries want to know if you are one of their taxpayers and should they try to collect their tax assessment from you. And both countries define that tax residency very differently. And it becomes especially important for those who spend time between Germany and the US. And many people actually accidentally trigger this residency in both tax systems without realizing it. So when we talk about the United States, we have an unusual tax system because it is based on citizenship, meaning that if you are a US citizen, you are always going to be liable for taxes in the United States, regardless of where you're located in the world. And interestingly, the same concept applies to green card holders. So if you hold a green card, you're a permanent resident, and you're living elsewhere, you still have the requirement to file your US taxes and pay taxes to the United States. Furthermore, even if your green card expires, the United States government still wants you to continue paying taxes until you go through the process of abandoning and surrendering that green card. And then also those who are just German citizens without the connection to the US can also trigger that same taxation requirement by spending a certain amount of time in the United States. It is a weighted average of number of days that you spend in the United States over the past 3 years. And essentially, it needs to amount to more than 183 days. And at that point, the residency is triggered in the United States, and you are required to follow all of the US rules on filing, all of the obligations to pay the tax on your worldwide income. So even the assets that are left behind in Germany would become subject to the taxation in the US. And for contrast, Germany's rules are significantly different. It is based more on your living situation and your personal ties. So, for example, Germany looks at your habitual place of residence. Where do you generally spend more time? Where is your family located? Where is the center of your economic interest? Where do you work? And they also have the test of 183 days that you spend in Germany would trigger that taxation there. And very similar to the United States, Germany also taxes you on your worldwide income, meaning that if you move there, your assets in the US become subject to the German taxation. So I think you get the trend here that both countries are they have pretty strict rules that follow the reporting requirement and the taxation. And then also an important topic that for those of you that are moving away from Germany and into the United States, there is a process for you to stop the taxation in Germany. So you must deregister with your local community, the office where you're registered, and you have to file your final tax return. And something important there is when that happens, there may be an exit tax in Germany, meaning that the assets that you own with capital gain may become taxable there, even if you're not selling that asset. So it's a form of a deemed disposition. It's only applicable to those who have spent significant amount of time in a country and have accumulated those assets while they were a German tax resident. And of course, within the US and German tax treaty, there are certain rules that dictate which country actually gets the first right to tax you if you are a resident of both countries. So there are certain tiebreaker rules like your permanent home, where is it located? And if you have more than one home, you have two permanent homes, where do you spend more time? Where are your vital interests and your family located? And then finally, when everything is equal, they do look at the citizenship as well, which now it became a lot more interesting because Germany now allows dual citizenship as of June of last year. So those questions definitely become a little bit more difficult to navigate. So we're going to switch a topic here and move to the next slide. And what we're going to talk about here is save early and often. So what types of accounts are recommended for somebody who's coming to the US? So saving early is a universal advice. The earlier you start, the bigger chance you have of accumulating larger wealth. But in a context of cross-border planning, where you save and how you save is just as important as how much you save. So the US and Germany treat retirement accounts and investment accounts very differently. There are certain accounts that are recognized by the US and German tax treaty, and that's what we're going to talk about here in this slide. The goal is to build a portfolio that is efficient while you're accumulating assets and then also in retirement to minimize the taxation while keeping your options open. We all know that just judging on my experience, coming to the United States was never going to be a 20-year stay for me. A lot of times people come to the US thinking that it's going to be a year or two, and that stay may be longer. And we never know. We see a lot of clients that decide to return back to their home country at some point later in life, perhaps to be closer to their aging parents. And that is a very common scenario. So in working with our clients, we help them structure their accounts in a way that would be beneficial and flexible depending on where life takes them in the future. So when we look at the main hierarchy of savings, we have these different retirement accounts like your 401k, IRA, and 403b. Those accounts are very powerful for those people who may consider moving back to Germany or stay in the US. They are recognized under the treaty as tax deferred, meaning that if you have a US IRA account and you move back to Germany, the taxation within the sale of the assets inside of that account and the receipt of dividends and capital gains and interest will not be taxed before you take the distribution from that account. So it maintains its tax deferred status, which is extremely powerful. And this is really one of the clearest and most valuable parts of this US German tax treaty. Now, certain accounts are not going to be recognized. Like, for example, 529 plans, HSA accounts, those are all newer accounts that were designed after the tax treaty was signed. And there is no recognition of those, of any type of tax deferral within those accounts. Similarly, Roth IRA is a great type of an account to have while you're in the US because it provides you tax-free growth. But that account is not recognized at all by the US-German tax treaty and actually would be treated just like a regular brokerage account. You would not be taxed in Germany on distributions, but you would be paying taxes on the current income earned within the tax year on that type of account.
Andres, just to make the point, if you came here and knew you were going to stay here for the rest of your life, all of these are really powerful structures for saving.
Yeah. Yep. Thank you, Andrew. And similarly, some of the German accounts are not really friendly when it comes to being a US tax resident. So, for example, if you're going to Germany to stay there for 3, 4, 5 years and you offer to contribute to German Pillar 3 contribution scheme, but your plans are to return back to the US, you should probably avoid it because for US purposes, it will be considered as a foreign investment account. It will probably hold some investments like PFICs that will not be friendly to the US taxpayers. More on that to come in the future slides. So the key here is designing the retirement drawdown strategy is just as important as the contribution strategy. So thinking about what is the reduction in income that you're receiving by contributing to these plans today versus what is the distribution going to be taxed like when you actually become taxable during the distribution time. One of the powerful techniques that some of our clients use is using cash balance plans that allow you to contribute significantly more to a deferred account beyond just the 401k contribution limits. And this is something that Germany does not have an equivalent of. So we actually have some German clients who come to the US, they're self-employed, they started this account and they're able to put away a couple $100,000 a year into those accounts before moving back to Germany and then having that account still tax deferred under the treaty. So we definitely have some really, really interesting tools to support that. And with proper structure and timing of your contributions and distributions, you can reduce and eliminate some of the double taxation and preserve the more of the long-term growth. Okay, so now let's talk about the timing of income and taxation of the income. In the context of cross-border taxation, timing also is just as much important as the type of an account that you have. So when you recognize income or gains, it can dramatically change your overall tax burden. So what we have presented here is a hypothetical taxation of either capital gains or U.S. retirement plan distributions if you are a U.S. resident with federal and state taxes versus a German resident. So I'm going to start with a couple of easy ones. Let's say if we're talking about capital gains and dividends. If you are a resident in the United States, your average tax liability based on your income would be around 20% on the capital gain realization. When you move to Germany, that tax will be at least 26%. So it's 26.3% with solidarity charge. So you could clearly see that there is a delta in taxation between the United States and Germany. So one of the strategies that we often employ for those clients who actually decide to then move from the US to Germany at some point is to accelerate the taxation and recognition of capital gains. So they can recognize the gains while they're only taxable in the United States and pay the lower tax rate here at 20%. And then another strategy is they could actually keep the assets that have underlying losses in their portfolio and bring those into the German taxation. So similar to the United States, Germany allows for carry forward of losses into the future years for unlimited period of time. So that is also very powerful tool is if you are in that cross-border situation, think about where that income is recognized and how that income is going to be taxed. And the timing of it is very important. Similarly with retirement plans in the United States, we will say an average married couple will pay probably up to a 25% effective tax rate on the distribution from their retirement plans, while in Germany, that could very quickly get up to 40%. So for example, if you're moving to Germany with a US retirement plan and your plans include buying a property and withdrawing a large amount from your 401k or IRA all at once to fund this purchase, the timing of it again is very important. It might be more beneficial for you to do so while you're still just a U.S. tax resident. Okay, and then
Andres, could
yeah,
I make one quick California specific comment on this? I just
sure.
want, Andres is based in DC and they've got decently high taxes there. We all know that the taxes in California are extremely high. And so you can imagine the peak, someone in the highest tax bracket with a 13.3% California tax on capital gains can be as high as 37%. Andres is trying to give averages here for people across America. But I only bring this up to make the point that when we're talking about timing of gains and recognizing income, taking distributions from pre-tax retirement accounts, we not only look at it between where you are in the US and where you might move to abroad, but we also go state to state. So there's very much opportunities. For example, and we've both done this before with clients, where we have people move to a lower tax location, call it Washington State, Nevada, or Florida, to then intentionally realize a large amount of income. Maybe it's from concentrated stock or selling a business or exercising options, and then experiencing that in a low tax state. And then after that's done, moving on, and it might be to Germany, it might be Spain, it might be Australia, Canada. So I'm just adding that the same way we think a lot about timing of realizing capital or taxable events between the US and abroad, there's a big impact that you can have on the state that you're living in at that time as well.
Yeah, thank you, Andrew. And something also important to note on that topic is that when we talk about a U.S. person, a green card holder, or a citizen being taxable in Germany at the same time, there is a system of foreign tax credits that will eliminate double taxation. So you will not have to pay 20% in one country and 26% in the other country. Essentially, you will only pay the tax in a country that has the highest tax rate, in this case, Germany, and you will use those taxes as a tax credit to eliminate your tax liability in the US. But with relation to the state tax, Andrew made a great point that California up to 13% tax is actually not creditable against by German taxes. So again, very important to understand that state taxation on the state level. Okay, so now we're going to talk about another topic, and that is equity compensation. So equity compensation is becoming a large part for many companies to attract their top talent. And when we think about RSUs, stock options, or deferred compensation, the key issue there is also timing. So grants vesting, the date when the vesting or the exercise happen, the taxation happens at different times in both countries. So the outcome can change once you move to Germany. The taxation is allocated by work days in each country. So, for example, a very common scenario that we see is somebody moving to the US to work for one of the companies that pays in RSUs or stock options, and they earn and they receive a grant in the United States, but that grant is not a taxable event. There still has to be some time that has to pass for those options or RSUs to vest. And if your tax residency is split between two countries, and if you're also considered to be a tax resident in Germany, then they may claim that part of the vesting happened while you were a German tax resident. So that's also a very important point. There is an allocation of work days, a system of allocation of these work days that you spend in each country that will contribute to which country will have the right to tax the gain, let's say, on the exercise of the option or the entire amount of the RSU, depending on where you were based at that time. So for clarity, the record keeping is critical. So you definitely need to have good records on when this equity compensation was granted to you, what are the terms of it, what is the vesting schedule, and where are you physically located during the time while these options or RSUs vest, and what are the terms of that, and also where you are a tax resident at the time. Um, earning equity compensation also often leads to holding concentrated stock positions. So we are seeing this incredible wealth creation from the large companies like Meta, Google, Apple, and we're seeing more and more clients that have these concentrated positions of very not diversified portfolios with just one or two stocks, perhaps. And in the context of this cross-border planning, realization of these gains, going back to the previous slide, the timing and realization of these gains and diversification, again, makes it that much more important. If you're selling a concentrated position to diversify while you are just in the US or when you're taxable in the US and Germany can make a huge difference.
I have a quick client example of this. I have a German client who spent 2 years with Palantir in Germany, then was able to move with Palantir to Australia, and then ultimately spent some time in the Bay Area for Palantir. He met his wife there, which was cool, and then they eventually moved back to Germany, and then he exercised a very large package of options, primarily options. And it was quite interesting how really wonderfully good the Palantir reporting was because they came back and basically had associated all the value that he had accumulated, invested, and associated it to each country. And when he exercised the options, they withheld tax and applied it to each of the three countries. And I know they stood out as being really on the high end of reporting because they have significant operations in Germany, Australia, and the US. Many companies don't. And so it falls to the individual and your tax advisor to figure all that out. But it's quite important because the rate of taxation is quite different in all three of those places.
Yeah, those building those spreadsheets could be quite a lot of fun. All right, well, let's switch gears here and let's talk about real estate. So real estate, it's one of the most common assets. It's emotional asset. It's tangible. You can live in it. You can rent it, and it oftentimes it plays a major role in long-term wealth creation. The challenge is that both U.S. and Germany have their own sets of rules on how they treat real estate purchases, sales, rental income, and so forth. So I'm going to run through these differences briefly. The main advantages that we receive in the United States are that for a primary sale of your primary residence, an individual receives $250,000 in exemption, while a married couple receives $500,000 in exemption and capital gains that will not be taxable. We also receive mortgage deduction and on the income, on the investment property income side, we receive depreciation deduction. All of this leads to a very low tax rate in the US on either the rental income from real estate or the sales of the properties. We also have the 1031 exchange option where you can defer the gain from one investment property by purchasing another and rolling that gain into that property. Germany, in principle, has very similar rules. So if you live in a property in your primary residence for 2 years before selling it, there is no capital gains tax. They also allow depreciation deduction on some of the income that you receive. However, if you purchase a property that you are going to be renting in Germany and you sell it within 10 years, then there is a speculation tax where instead of enjoying the capital gains tax brackets, you will be paying earned income tax brackets. And in Germany, they're 45%, so quite a big difference there. One other thing to mention is if you own a property in the US and you're moving abroad and you're not sure about how to treat that property, whether you should rent it and keep it or sell it before you move abroad, when it comes to Germany, there is one trap that we often see with our clients. So if you have a property in the US and you lived in it full time and now you moved away, you have 3 years to sell that property and still receive full exemption from capital gains in the United States. So you can rent it for 3 years or for 2.5 years and sell it before the 3 years is up and receive that full deduction. German rules are different. So you actually have to live in that property for 2 years before you sell the property. So if you are in the United States and you have a home in the US, you move to Germany, become a German taxpayer, their rules will not align with the US rules. So there, you could be in a place where you are receiving the deduction in the US, but Germany taxes the entire gain on your home that's located in the United States. So again, this is a common mistake that we see very often. It's the one that we carefully plan for. And here I'll turn it over to Andrew. You're on mute, Andrew.
I saw that I was muted, and it took me a while to unmute myself. There's a lot going on in this slide, clearly, which I'll talk about. I'll try to make it a little bit more simple. Ultimately, this discusses the challenges that cross-border international people face when dealing with financial institutions. In particular, foreign financial institutions, in particular, European, EU institutions. And ultimately, one of the biggest difficulties is when someone becomes um, a US tax resident, they're going to be affected by something called FATCA. And let me explain what that is before I walk you through a little bit of this slide. Back in the 08, 09 scandals, when the UBS, the Swiss and Liechtenstein bankers were caught coming to the US and enabling Americans to evade taxes. It was a big scandal. You probably remember the German government was purchasing the lists of from a disgruntled Liechtenstein broker, and were purchasing their client list. Italy did it as well, trying to uncover all these prominent figures that were hiding their wealth in Switzerland. Well, one of the outcomes of that was FATCA, which is a US law that requires all foreign financial institutions to poll any individual client on a US taxpayer status, whether that's a citizenship or green card or visa. And if they have it, they are required to report annually the net affairs of that individual with the bank back to the U.S. Treasury. Well, none of them want to do that because it creates a huge reporting burden to them. And if they are found to have failed to deliver that information, they risk being cut off from the U.S. financial system, which means the out of business for any international financial institution. So it's created a real challenge, and many of you have no doubt been sucked up into this challenge because ultimately this causes a lot of foreign banks to not want to work with someone the moment they become a US taxpayer, right? Many of you probably have a bank account, a regular bank account from before you moved to the US where they don't even really know you're in the US or it's kind of a vague and leave it that way. It's fine. But let me walk through a couple of areas from left to right where this causes problems. Okay. Firstly, EU rules will not allow someone, they require anyone resident in the EU and any investment account in the EU can only purchase investment products that are regulated by the EU and fall under their standards of reporting, right? Well, so those funds are not necessarily appropriate for an American, and if you're registered as a US person with that foreign bank, you won't be allowed to purchase them. And so it creates this real awkward situation where you can't buy the US, you shouldn't buy the EU funds, and you can't buy the US funds that are appropriate for you from inside of that EU account. Okay. Secondly, a US person living in the EU, where the investment firm that you work with in the US knows that you live abroad, you have a bunch of restrictions on the types of US products you can buy. You mainly cannot buy open-ended mutual funds like a Vanguard mutual fund. And so you get in this sticky situation where if you're in the EU, you can't buy EU products because they're not appropriate for the US system. And you can't buy US products because they're not offered by any European banks. And you may have a hard time owning US funds, right? Or purchasing US funds. So now the third button is if you're a US person in Europe and you were to buy EU restricted funds, like maybe you didn't check the box, or maybe you had an account from long ago and you just never notified the institution that you have become a US green card holder, as an example, you could buy an EU fund, but it would be a PFIC for US purposes. And a PFIC is a passive foreign investment company. It's basically a tax law in the US intended to discourage Americans from getting involved in any kind of offshore investment structure. And the way they do that is there's a very onerous reporting back in the US if you own, PFIC investments, which all mutual funds outside of the US fall under this PFIC. So it's very onerous reporting and you have mark-to-market accounting at the highest tax rates. So it's really, really bad. And generally, you ought to get out of any PFIC investments that you're in. We'll come back to that in a moment. So the fourth box there talks about the EU banks once if they find out that you have moved to the US. And Andres and I were just talking about a situation his client is in. It's a German living in LA where he had an investment account that he decided to leave in Germany. and he lost his his European mobile, and so he loaded his new US mobile number so that he could do two-factor authentication and log into his account. And they immediately realized he was in the US, and they mailed him a letter letting him know that they were going to be closing his account. And if they had not heard instructions from him in something like 60 days, right, Andres, they were going to liquidate all the investments that he had in his account.
Yes, it was actually less than 60 days. It was something like 3 weeks they gave him, and it came from Trade Republic, which is a German trading platform. It was a very forceful letter.
Yeah. And so the point we're trying to make here is you have a lot of regulatory whirlwinds or winds or swirling winds that involve both US law, EU law, and frankly, a German US person gets really wrapped up into a lot of that. And of course, if you're someone who has a lot of assets or you've been a good saver, you get especially wrapped up into it. And the key point we want to make about that is, you know, the US, European, US, German people are often in a situation where they really can't do anything easily, right? And so our ultimate recommendation for this, and it leads to my next slide, is that once you become a US person, whether it be a green card or a dual citizen, you really ought to primarily keep your investment assets in the US. Now, this is not necessarily bank accounts where, a lot of people have bank accounts and it's efficient for them to keep accounts in two countries, three countries, and we're a big believer in that, right? But we are also a believer in making the transition of your investment accounts here to the US. Okay. So ultimately, the US system is not perfect, but it is the best regulated capital system in the world. It has the lowest cost investment structures available with the most investment choice. As an example, there's more European focused mutual funds in the US than there are in Europe. And that I'm quoting from about 10 years ago. That may not be true today, but you get the point. There's a lot of capability here in the US to build a worldwide investment portfolio. The second point here is that US taxpayers, whether you're just on a green card, whether you become a dual citizen, you need US compliant reporting. And that's especially 1099 reporting, which lays out short term capital gains, long term capital gains, dividends from equities which are qualified and receive the lower tax treatment. You don't get any of that if you invest in pooled investment structures outside of the US. The third bullet point here is an argument to say that we can create globally diversified portfolios from within the US. We use a lot of, we believe very strongly in keeping our investment structures as simple as possible, as clean and transparent, as low cost as possible. We sometimes will build around that with things like alternative investments, private equity, venture capital, real estate structures. But ultimately, it should be clean and understandable and match the needs of our clients, their risk tolerance, the level of their wealth. We can use things like separately managed accounts and even direct holdings that are non-US securities. Andres and I are frequently buying German individual equities, French, UK, and also non-US bonds and fixed income securities because we have a lot of clients that maybe do want to move back to the US and they are concerned about having a primarily US dollar centric portfolio, right? We've been hearing more about that over this last year than in the past. We all know that the occupant of the White House has changed, and there is more thought to the dollar and on, potentially one day retiring outside of the US. But the US jurisdiction is where we believe people should have as the base of their investment wealth globally, should be based in the US. And that's even if they were to one day retire outside of the US. Now, if they decide one day to retire and give up their green card or give up their US citizenship, that's a totally different matter. That's expatriating, brings up a whole lot of other issues that Andres and I have dealt with many, many times. So the watch outs here on the right, and I'm going to keep this moving, getting my warnings from Andres. Go back real quick, Andres. The watch outs are there are issues when you move to the US and you have investment structures from before you move to the US. Those can be a challenge to figure out how to deal with. And oftentimes, frankly, it's best to liquidate them. You can inherit investment structures outside of the US. We see that a lot. Or you may decide to gift structures, and there are different rules for gifting investment structures that are not US compliant, that are outside of the US. Okay, thank you, Andres. Let's keep going. Estate planning is an area where I'm going to spend a lot of time, and I'll be pretty quick on the last two slides. This is becoming more and more important, I think, demographically. Obviously, we all know that there has been a huge amount of wealth creation around the world, and in particular here in the Silicon Valley. And we also have aging demographics, right? Both our parents and then, of course, us, and us thinking through how we're going to pass wealth to our children. Real quickly, I'll give a little contrast between the US and the German system. Of course, every country has its own system of wealth transfer and laws of succession as well, which we'll talk about. There are estate tax systems and inheritance tax systems. That means that, for example, in Germany, the tax is on the recipient, and in the US, it's on the estate. Of course, the US is well known for having a very, very generous exemption of going into 2026. It will be $15 million per person or $30 million that can be transferred to heirs, anyone that you want in the US. And in addition to that, upon death, the heirs receive a step up in basis, meaning that it may be highly appreciated real estate or securities that is immediately stepped up. And so the heirs they can liquidate at any time with no tax impact. So really, really generous. There is also a vast array of trusts and other wealth transfer strategies that we use very commonly here in the US that allow for discounts and gifting early in one's life, assets that are likely to appreciate, where you can pass a lot of wealth to your heirs. Okay. A lot of those systems, we find a lot of our clients that use big banks in the US as their primary investment partner who deliver to them advice that's extremely US centric, and they end up creating a lot of complicated trust structures. But if they plan to retire abroad, or if their heirs live abroad, will not work and can cause huge problems. So be careful and understand that you may have a more global lifestyle. The German system is very different. They have a forced heirship where children are entitled by law to at least one half of their statutory share. If they're two kids, those kids are by law are entitled to half of their assets. However, if you are a resident in the US, you can, or anywhere outside of Germany, you are allowed to elect different laws for this heirship rules. So that's actually a pretty interesting rule that has quite helpful if someone doesn't want their kids to receive all of their assets. I'm not going to go into a lot of the tax system, but as I said, they tax the recipient, not the estate giving the asset, the gift. But if the recipient is not a German resident, they'll tax the estate itself. So they're not going to lose out on any of that. And then the rates can be very high and they depend on who's receiving the gift. They have some other rules that are interesting about passing real estate down, which some of you may know about usufruct systems and other systems, but we're going to skip on. They don't recognize trusts. They're generally looked through. So that might mean they don't work at all if you were to one day move back to Germany. Okay, let's keep going, Andres, because we
Um,
are running out of time.
yeah, Andrew,
There
we
are
need about a couple of minutes for questions. We do have
Okay,
a
I'm
question.
going to just run through these last two really quickly. Banking issues are pretty complex. We do recommend people keep banks both abroad and in the US. Can make things easy to move money around and hold foreign currency. And Andres, let's just quickly do the last one. We think it's super important to have a coordinated team. We're often working with US tax advisors and German tax advisors, or even in other countries, as well as estate attorneys, and of course, wealth advisors. It's really easy to get siloed advice that the expert you're talking to only knows the rules that they are used to dealing with. And that can really cause problems for people like you who actually need someone who's flexible and can understand and adapt to multiple laws and how they work together. That's really ultimately our purpose. So let's move on and try to answer a few questions. Sorry I went long.
Wonderful. Thank you so much. I do admit, Andrew, you lost me at PFIC. I think you might have to go through that one again. But let's go into the question and answers round. I do have a question here in the chat from Barbara Kempen. If you inherited a home, kept it for 10 years, and then sell it in Germany, and then transfer the money to the US, what is the best strategy to do this and tax implication? The state is California.
Yes, so maybe I can take that. So if you inherit a home, I'm assuming in Germany, and then you keep it, sell it, and you transfer the funds back to the United States. Um, a couple of items to mention here. If you own the property and you sell it at some point, and if there is any type of a gain that you're going to generate, then that gain is not going to be only taxable in Germany. It's also going to be taxable in the US and in California. So that's one thing to think about. The other is if you're renting that property during the time, you would need to report that income both in Germany and in the US. So that's another topic. And then the last part is, of course, if it's a large sum of money that you're transferring from Germany to the US, you want to be efficient around the conversion. So we always say the worst place to convert funds is the airport. The second worst place is the bank. So avoid those two places and convert somewhere else.
And
So
one thing to add too is upon inheriting that property 10 years ago, you'd have a stepped up basis for US purposes. So you'd only have a taxable gain in the appreciation from that date, but that may not be true for Germany. And there is a possibility that you could have a tax in Germany and then some tax in the US. You'd get a credit for whatever you paid in Germany, but that would not offset California tax. So we've seen situations where people have something like a 60% tax on gains. So there's some pretty weird things that can occur.
So maybe we can go through three or four more questions, and if I could ask you just to keep the answers fairly short so that we can get to them, and then of course also go into the one-on-ones after that. Um, from Florian Leppen, we have coming from Germany to the US in 2025 will be my first year. I'm taxable in the US. I liquidated all my stocks and ETFs from German brokers, including Trade Republic. German brokers withhold German tax. Will I run into PFIC issues, double taxation, have to declare all those gains as a foreign income?
maybe I can take that as well. So very briefly, based on that fact pattern, probably not. So if you liquidated those holdings in the same year when you are taxable in the US, you're right, there is withholding at the broker at Trade Republic, but you can also declare that same income in the US and take the tax credits to offset any US tax liability. But selling it is great job, Florian. So you don't have to deal with it later.
Perfect. From Thomas Vogel, we have, what about eligibility for Social Security and Medicare if you contributed only for a few years while working in the US? These can be considerable benefits or additional expenses to take into account in a long-term plan.
Andrew, you want to take that?
Yeah, this is a good question, and we get this a lot. Ultimately, you're accumulating this benefit, your Social Security. Obviously, there's minimum requirements to qualify, but it's very, very common for our clients to have built up Social Security benefits in two places. And that is your property. You take that with you. So even if you were to move abroad and even give up a green card or even give up US citizenship, whatever you would have earned from US Social Security is still yours. So we have many, many clients who spent a decade here in the US and then they are receiving their Social Security wherever they're living now.
From Secret Grave, we have how are euro-denominated bank balances treated for US tax purposes when US tax statements show apparent income solely due to US dollar-euro exchange rate movements? If no conversions occurred and no actual interest was earned, are such unrealized currency fluctuation taxable? Additional, what options exist when the foreign bank does not provide statements in the original currency to document the absence of a realized gain?
I'll take this one too. I mean, the second part first, reporting back to the US on any kind of investment structure, whether it's bank accounts, individual securities, and especially pooled investment funds like a mutual fund, is always a manual process, bringing it back to fit into the US system. Again, that's why we recommend basing investments in the US where you're receiving 1099 reporting. The other part of the question was about sometimes there's income that may not actually be real income, that it's only a result of currency swings. And yes, absolutely, those are issues that can affect people, and we see it all the time. It's less of an issue with like interest income on a bank account because that's pretty obvious. You earned 2% interest, and that's ordinary income. If you pay tax in Germany, you would report it as income here, and then you get a credit for whatever you paid or whatever was withheld in Germany. But more often than not, where we see funny things is if you purchase an asset, could be real estate, it could be a security, where it actually over, let's say, 3 years, it does not go up in value, or it might even go down in value. But because of an increase in the euro relative to the dollar, it actually becomes a taxable gain in US dollars. And absolutely, that is 100% taxable. And it always is upsetting to people. It's like, hey, I invested $1 million and I got 900 or a million euros. I got 900,000 euros back, and it was a $100,000 gain. And we indeed have seen that.
So, Andrew and Andres, we have a couple more questions, and if you have 5 more minutes, if we could go through them, that would be great.
Sure.
So, I
Sure.
have Catalina Lange asking, I recently moved to the US on a visa. My parents want to transfer a share of a property to me this year, which is not due to be sold for around 4 years, when I will probably be living in Germany again. Will the increase in value still be taxed in the US as I already owned the share beforehand?
This is a, this is a tough question. I can take
I,
it. So for one, you probably would want to disclose the receipt of this gift if your parents are non-residents of the United States, and it's just an information disclosure. There's no taxation that happens at the time in the US. Um, and when the time comes to sell the property as the part of the owner of the property, of course, you will have a gain that's going to be generated. And then the question is, I think depending on the states, on the federal level, it's probably not going to be taxed, but on a state level, perhaps if you live in California. This is a really technical question. I don't know if Andrew, if you want to add
well,
anything.
and I'll just add this. It's Germany and a number of other countries in Europe do have very, very high inheritance taxes, but they have a few special systems to pass assets to children, often real estate assets, right? And a lot of times those those systems, and I'm thinking of like the usufruct as one example, where you gift the ownership tax free or inheritance tax free, but the right to use or the right to the income during the parent's lifetime stays with them. And we don't have anything like that here. And so you end up getting really into a pickle where you're taking advantage or your parents are taking advantage of a structure that's efficient in Germany, but it does not speak the same language as the US system. And it can cause a lot of problems. And this is one example of that.
Okay, two last questions. One is from Ray Stelhorn. How are the cash values proceeds in a life insurance policy treated if you are a US citizen living in Germany?
So in general, life insurance proceeds would be tax-free in Germany. The cash value, that's a very difficult question to answer because Germany has rules depending. They also have contracts that are similar maybe in nature to our whole life insurance policies that have a cash value. So generally, if it's a German product, the gain is not going to be recognized until you take any distributions from it. But for a US policy, definitely would want to have a German tax advisor look at it. This is also one of those very technical questions. But something to remember is even though the proceeds from the life insurance policy may be tax free, there may be still an inheritance tax on the person receiving the inheritance. So
This is a good
something.
example of structures that have tax advantages in one country, and it's best to not assume that that will accrue to another country, right? And of course, you have life insurance in Germany. It's actually a big part of the retirement plan. It's often sold in the bank branch, right? In whatever your local town. But it's often the case where our structure doesn't necessarily comply, or it's open to the interpretation of the tax professional that you're using. And so it kind of puts you at a little bit of risk, relying too much on the tax benefits that are intended for just one country. We see that kind of thing all the time.
Okay, last question is from Dagmar Delachko. Estate planning for seniors with dual citizenship and financial assets and property in both countries. Do they need estate planning documents in both countries, especially since the US trusts are key? Since
Yeah.
in the US trusts are key, but they are not recognized in Germany.
This is a wonderful question, and we're dealing with this all the time. We have German citizen clients where maybe one child is located in the US and another one is in Germany. We're dealing with a client just like that right now. And it's super odd because imagine, $10 million dollars with 5 million going to each kid. And the child who lives in Germany, the net that they would receive is dramatically less than their sibling who lives in the US. And that's just one example of, probably 10 or 20 different unique elements that are a part of the question that you just asked, Jeanette. But ultimately, you do have to bring in profession. If you have assets in multiple countries or heirs in multiple countries, you have to get a team together. You have to understand the issues, and we know the issues in the US tend to be pretty lenient for passing wealth down, much less lenient in Germany. So you have to kind of unify and make sure you've thought through all those different rules. And a lot of people have real estate, for example, back in Germany that's part of their plan, and they want to gift that real estate according to German rules, whether it be usufruct or some other rule, but it just won't work. So ultimately, you need to get a team together. You need to realize that the structures that we use in the US, like trusts, are definitely not going to work, at least for the assets that you have that are outside of the US. So, yes, you need to have advice on both sides, and probably you need to have documents, wills and other documents that are intended for assets that are in each of those countries. We help put that together, but it's never easy, and you can never be 100% certain of what the ultimate outcome will be.
Andreas, I just want to thank you. This was amazing. And I'm sure there are a lot of questions left. And as we said in the beginning, we are reaching out to everyone who's registered here. You kindly offered for our members to be having a one-on-one session with you to follow up. I also want to thank you for your amazing partnership. You have been with GABA for such a long time, have been a staunch supporter of our mission. And I really, from the bottom of my heart, want to thank you for that. And I think it's a great cooperation that we have and hope to continue it. So thank
We
you.
appreciate you. Yes.
So thank you very much. Again, to everyone who is still on the call, we will be sending around an email with the recording and also your all the emails that you can reach out to Andrew and Andres. So thank you everyone for coming. Have a great lunchtime, and we'll see you next time.
Cheers.
Bye bye.